Hi, this is Michael with Back to the Future Trading, and I wanted to share some thoughts with you about the spring pattern that we've been talking about here. There's been some developments, and I wanted to give you some background on what I've been studying and pose some questions and maybe get some help doing this analysis. I've got some ideas, but I wanted to share them with you. The spring pattern has been playing out perfectly, and I want to show you what I mean by that. So the chart on the right is 2017, and here's 2016, and a lot of you have seen this analysis before. And so the pattern that we're tracking is, you can sort of pause the video and follow these blue lines. I use these predictive markers as anchors to see where I am in the sequence. Historically, these little green dots and these larger green dots, these are phase 1s and phase 2s. The little red dot is a phase 3. The large red dot is a phase 4. And this time last year, we have a tremendous similarity in the patterns one to another. And without getting too crazy into this, I've just sort of put some numbers here to help you see where the similarities are. Meaning after the phase 4, there's a run up to a high. Then there's a pullback down into a low. Matter of fact, let me get rid of all these numbers here, and I just want to walk you through the basic sequence, because once you see it, you'll see why I've been pushing this idea of the spring pattern for so long. Again, this is May of 2016, and so here we go. We have the phase 4 and then the run up. So that's number 1. We have the high. That's number 2. Then we have the pullback into a low. That's number 3. We have a consolidation period that ends. That's number 4. Number 4. Then we have a drop. And the drop is at that little red dot, which is a phase 3 day. And you'll see the same thing happened 1, 2, 3, 4, 5 in 2016. And then here's what's really crazy. The phase 4, that large red dot, the day that was predicted, turns out to be a stop run low. It's a spike low, a pin candle, a plunge candle, whatever you want to call it. And the same thing happens over here. You see that same plunge candle right at the phase 4 day? So the banks followed that pattern all the way up to number 6. You get to number 7, and then you have the beginning of this consolidation phase. So over here, that's number 7 as well. And that occurs at a phase 1. Then, here's where things get interesting. The 8th part of the sequence is the launch from the phase 2. The launch from the phase 2. Now, in 2016, we have a channel. Just like in 2017, they followed the same channel. In 2016, however, they stayed above the midpoint of the channel. And I'm just going to fill in this kind of tube right here. All right? And do you see how into the phase 2, this large green dot, they stay in the channel and then they break out and continue into higher highs? That's what I've been expecting. And let me continue to show you why I believe that. If you go back into 2015, the same thing happens. 1, 2, 3, 4, 5 all the way down into the little green dot over here. Then we have the phase 2. Okay. if I draw those same kinds of trend lines and those same kinds of channels, I want you to see, just as we sort of connect everything together, that the same channel occurs in 2015, 2 years ago. But you'll notice at the phase 2, this large green dot, which is where we're at here, number 8. Let's call that number 8 in the sequence. It stays above in the top half of the channel. Again, I'm going to draw the same box. See that? So 2016 stays in the tube. 2015 stays in the tube. If you go back to 2014, stays in the tube. Follow the angles. Ready? In the tube. And while it's not perfect, that's probably closer to it right there. Can you notice that after the phase 2, what I've been calling number 8 in the sequence, that it stays in the upper half of the channel? So that's 2014. We're back 3 years now. Let's go back to 2013. Ready? Continuing back, the same spring pattern. The same 8-point sequence. Okay. In 2013, there's a variation. Okay. The channel isn't quite the same, but I want you to see that as of the 8th part in the sequence, even if we extend it up like this, and I'm just hunting for a trend line. Let's see, like here, the midpoint of that would be over here. By the 8th point in the sequence, we're out of the band altogether. You see that? So there's no bearish winds blowing when we get to that phase 2 large green dot here. And then the number 8th part of the sequence launches us up into a new high. Well, things get weird when you start going back into 2012. And in 2012, here's what I'd like you to see. This is 5 years ago. And in 5 years ago, it's the same sequence of events. And the only different part about the sequence is that the 7th part of the sequence went high instead of coming down. So this green dot in every other sequence was down here. The market didn't go up into a high, it came down into a low. But other than that, every other part of the sequence is the same for the spring pattern. Here's where we have a telltale sign. Okay? And many of you have already figured this out mentally. Mentally, you've probably already locked into the fact that I've already drawn this channel here. I've already drawn the band where the bars are supposed to stay inside of. And you'll see in this spring pattern back in 2012, I've got this yellow box highlighting a telltale signal. A wiggle, a twitch that shouldn't be there. And this candle right here drops out of the upper half of the spring channel. Now this is again 5 years ago in 2012. This pattern, if you align it with what we're looking at to the left, right now most closely resembles what we're seeing current in 2017. I initially told you what support levels to look for, and I caught a very nice move back up. I had, I think, $7 or $8 on one contract, 2 on a second, 3 on a third. And so I was really good about catching the first drop down over here when we were looking for support. But I was not anticipating this bar right here. I wasn't anticipating the bar to drop out of the channel. And the very first time that I thought to even look this far back was in 2012. And so I'm wondering, looking at this chart in comparison to the other 5 years worth of patterns, if we aren't witnessing the return of the sell in May and go away, because there are tumblers of the lock rather, falling into place that aren't following the other 4 years of bullish reversals. And so the very first sign that I see is dropping us down into this lower channel. If this is the fall, then we can make some very clear projections about where our pattern over here should go. Let me show you what I mean by that. We can take the channel that has been prominent in every one of these examples, and I'm going to double that channel size. Do you see what I did there? The distance between these two lines, I'm now making an approximate jump down. You got what I did there? So the distance between these two lines is important. And I'm going to take that now, copy it and paste it. And that's where the bottom of this line comes in. Well, if that procedure is accurate, then I should be able to do it over here. And so if I draw a blue arrow like that, we'll stretch it out just a little bit, then there's a very strong likelihood the bottom channel, if it continues to fall, will bring us down into a revisit of the low 2300s, 2304, 2300 as the retest. And it all comes back down to what happened today. It all comes back down to this candle that we just spoke about. So I'm going to highlight this one, and then I'm going to draw it over here. This candle doesn't belong where it is. We should have seen the bar come up and follow the tradition of the last 4 years, 2016, 2015, 2014, 2013. And here in 2012, it dropped down. So we have this pattern. This is great news. We have this pattern, and the banks own this move to rights. They own it. They have every right to move the markets higher. And so this is a critical point for me in terms of my analysis, because for me, if it touches this lower line, that's the last lock, the last tumbler of the lock. If we come back down and we retest over here, which right now is 2330 on the Emini S&P, then we've just about sealed the deal, because the sequence of events is very clear. Close at the line, close below the line, retest the trend, and then drop down to the extension of the trend. Okay? If we somehow are able to climb back up into the upper half of this fork then there's hope for the restoration of that bullish reversal. This is the pivot right here. But as of right now, the phase 2, the time where the energy exists to drive buyers higher, where people are more inclined to buy, where people are more inclined to take risk, the banks have opted out of that position. They are standing aside and letting the selling continue. We had that initial stop run. That was a big vociferous candle right here. There were the previous swing lows. One there, one here, and then they kept, I call these fishing expeditions. They kept dropping the hooks deeper and deeper, shearing the sheep every time they came down. And I thought for sure when they touched that lower trend line, they were going to break out and continue up. And then I have this crazy ass candle that hasn't shown its face in 5 years. Okay, so I'm curious what your comments are, what your thoughts are. If you see this as the logical sequence of events, how much further back can you go to do these kinds of analyses? If you have 4 out of the 5 last years driving that pattern higher, can we just assume that this is a short-term fake out? Or are we likely to assume that that year was just a fluke? Because here we are in 2011, and can you see what happened? I've obviously put a lot of thought into this, right? Same pattern, the same sequence of events. Pause the video and check 1, 2, 3, 4, 5, 6, 7, 8. And do you see how we stay up here in the upper band in 2011? That's 6 years. 5 out of the last 6 years, the market has gone up into new highs, which is 2,400 from here. So as of right now, this is about the lowest risk trade I know of in recent memory, where stops are just below this red line, say 23.29 to 23.37. So there's about an $8 risk to go from 37 to 97, 60 points up. For those of you who are so inclined and your research aligns with what I'm finding here. But for that one very troubling, very glaring drop out of the channel, this is the only year, I can't say it enough times, this is the only year of the last 6 years where we dropped out of the upper half and continued down. We shouldn't be this low this far in the game. The banks have stepped aside and ceded their right to drive it higher for a reason. And I don't know what that reason is, other than if this is the clincher, then the pattern will follow accordingly. We will come down, retest, go to the extension. We'll get there by the next phase 4. We will, at the bottom of the phase 4, come back and test the midline by the phase 1. We know when the dates are coming. We know when the next phase 3 is. And then we drop down into the lower extension. Let me show you what I mean. Ready? Copy, paste, drop down, copy the line, copy, paste. Watch. Can you see here? I'm going to extend the line out, keep it parallel. And there's the extension by the next phase 2, which is in about 27 days from now. If this sequence falls below the bottom trend line, again, I'll color it red so you know where I'm looking. That is the new pattern. That's the one the banks have opted to follow. Drop into the first line. We'll color that one green. Drop into green by the phase 4. Pull back into dotted purple by the phase 1. Drop into the second extension, the tomato line, by the next phase 2. So that's all I know about at this point. I don't know any other subtleties or any other research I can do. I thought for sure that we were following the 2016 version of this. However, that one candle breaks us out of that channel, and I'm not sure that we can recover from here. The end of the sequence would be a touch and a close below the red line, and that will tell me that we're going into the 2012 sequence instead of the 16, the 15, the 14, the 13, and the 11 sequence. So pretty big shift if that's the case. Tell me what you think in the comments. Email me. Let me know if you see anything other than what I've been able to uncover here. If you're a Flex customer, please use your predictive software when referencing this. Like us and subscribe to us down below. If these videos are helpful for you, please let me know and join up with us as subscribers so I know to continue putting these out on a regular basis. Thanks again, ladies and gentlemen. Remember, the market you trade is not random. Please take the opportunity to visit us every Thursday afternoon where we go over this, as well as the intraday predictions for all of the futures and forex and equities markets that you trade.